So yeah, I ended up recently watching Bill Ackman on Lex Friedman's podcast, and given how similar his investment philosophy is to Keystone's, and how much I just really enjoyed listening to the podcast itself, I thought that I would cover him as an investor spotlight on our own podcast. So to give you a quick rundown on his life, Bill was born in 1966 in New York and graduated from Harvard in 1988 with a social studies degree. And in 1992, he received a Master of Business Administration. He is a value investor as well as an activist investor with a strong influence from Warren Buffett's investment style, with a focus on simple, predictable businesses with strong cash flow. And he references Benjamin Graham's Intelligent Investor as being very formative in his career in teaching him the difference between price versus value. Now, in 1992, Bill founded his first fund, the Gotham Partners, with fellow Harvard graduate David Berkowitz. And after early success in the fund, he ended up shutting it down in 2001 due to some ill-timed bets, lack of diversification, and dangerous concentration in illiquid investments that could not easily be sold when investors wanted their money back from the fund. So this led him to eventually start Pershing Square in 2004, which became a top global hedge fund known for its activist investment approach and substantial annualized returns. The fund began with approximately $54 million in initial capital and generated a 17.1% annualized return between 2003 and 2021, or I believe 2004 to 2021, where the S&P 500 did, I believe, about 10% over that same period, where he now has about $18 billion in assets under management. So since Pershing's inception in 2004, his PSLP fund, so this was the fund that he started right at the beginning. He's now added another fund, but his first fund has returned a cumulative net return of 1,979%, while the S&P's cumulative return over the same period was 535%. So let's take a look at some of his investing successes, as well as some of his major losses. So number one, this is a success here, is General Growth Properties, Inc. This was the second largest commercial shopping mall REIT in the United States that was essentially facing difficulties in 2008 due to the global financial crisis. And up until the financial crisis, Bill stated that many people saw malls as being undisruptible. Looking at that now, how funny that is. But essentially, the CFO of General Growth was very aggressive in the way that he borrowed short-term money, which led the stock from about $63 per share to 34 cents and led the company to essentially go into bankruptcy. So while General's debt was worrisome, the fundamental drivers of malls are occupancy and net operating income. And from 2008 to 2009, Bill said that these fundamentals were actually improving, which led him to buy about 25% of General Growth's shares. And Bill was able to actually get on the board of General. They restructured the business and the stock climbed back to $31 per share. And again, he started buying at about 35 cents. And once General Growth recovered, the company eventually spun off into two new companies, the Howard Hughes Corporation, which still trades today under HHH on the New York Stock Exchange. And that split off in 2010, as well as the Rouse Properties, which split off in 2012, with Pershing still holding about 38% of Howard Hughes holdings. Now let's move over to CP, or Canadian Pacific. So Bill first invested in Canadian Pacific Railway in 2011 when the stock was trading around $69. And his investment thesis was based on CP underperforming Canadian National Railway, or CNR on the TSX. And Bill was very critical in saying that CP was the worst run railway in North America, and said management would blame any underperformance on the weather, essentially, which Bill called BS on. So he saw it as a good company, but it was poorly managed, which led him to take a 12% stake in 2011. And Bill, at being the activist investment that he is, he tried to get Hunter Harrison, a veteran railway CEO, to meet the board to potentially run the company. But given the board would not meet with Hunter Harrison, this led to a proxy contest, and the then current management and board of directors was voted out. And Bill was essentially forced to sell his initial investment in 2016 after, I believe, about a 3 times gain when he had a run on capital at his fund after a few poor investment decisions were made, and people were worried, so he needed to raise liquidity to basically pay people out or give them their money back. But more recently in 2022, Bill actually re-entered into a position in the stock into CP and says that if he actually held onto his original position, if he didn't have to liquidate because of liquidity needs, the position would have actually returned approximately 11 times his initial investment over the time. So there's a couple of his gains. Now let's take a look at a couple of his stinker investments. So number one, in 2012, Bill took a short position on Herbalife, HLF, on the New York Stock Exchange. And his short position was valued at about $1 billion. And his thesis was he believed that Herbalife's business model was an illegal pyramid scheme which would target minority communities who lack business acumen. And although Bill was able to successfully gain the attention of the FTC, which led to Herbalife paying a $200 million fine and was forced to reform some of its business practices, in 2018, he threw in the towel on the short position for a loss of approximately $1 billion. And, I could also elaborate a little further on Herbalife in that Carl Icahn tried to short squeeze Bill or Ackman's position on Herbalife, leading them to have their famous exchange on CNBC where both of them slandered each other live on air. And if you actually just, YouTube that, you can rewatch it. It's entertaining nonetheless. The other one that was his biggest loss was Valiant Pharmaceuticals, and this is Quebec-based Valiant Pharmaceuticals, where he lost $4 billion. And he notes on the podcast with Lex that he had avoided pharmaceutical companies generally due to their complexity, but decided to make his first passive investment in 2015 because another activist investor was governing Valiant's board. Obviously, they weren't doing a very good job. However, the company ended up making a series of decisions that were disastrous, including drug pricing investigations and improper accounting allegations, which led the company to be subpoenaed by U.S. prosecutors. Bill ended up actually doubling down on his investment, backing the company. But in March of 2017, he sold his final stake in Valiant. And just, you can see the destruction in capital there from, 2015 to 2017 that I have up on the screen here. So just to finish things off here, just quickly looking at some of Pershing's other current holdings. Bill has voiced that one of his most successful industries to invest in has been the food and beverage industry. He currently holds a position in Restaurant Brands International, or QSR, on the TSX, as well as Chipotle, which is CMG on the New York Stock Exchange. And he says the reason for his success in the space has been due to finding restaurant businesses that have good systems or ones that he can implement systems so that he can create efficiencies and replicate for, future growth. And for example, I was talking to the guys about this the other day. We could really relate this to the Boyd Group as one of the reasons that the Boyd Group was so successful in growing its stock price from around $2 to above $300 today is because of the implementation of systems. Boyd was acquiring mom and pop auto collision shops and introducing Boyd's systems into the businesses to create efficiencies, which gave them obviously a really long runway of growth. Now, another name which Bill owns in the portfolio is Alphabet, or Google, or GOOGL on the NASDAQ, which he began to invest in 2023 when people's concerns were misplaced over the company's AI positioning. So what he says is with the introduction of ChatGPT, the market decided that Alphabet was falling behind in AI, when in fact, Google has led the world as the dominant AI player up until this point. Or I said Google, I mean Alphabet. And according to Bill, Alphabet likely held back on introducing its own ChatGPT to the market due to the potential scrutiny that, regulators would place on Alphabet being such a, powerhouse, a global powerhouse. But, given OpenAI was a startup, they receive much less scrutiny. And as such, given the sell-off and its valuation, Bill declares that it is one of the most attractive of the Magnificent Seven at this time. Now, to kind of bring things full circle here, I will leave you with one quote from Bill. And to bring it full circle, this is in relation to Brett's kind of thematic top-down investing segment. So Bill says, "We try to find very robust, stable businesses which are only very modestly levered, and as a result, we don't need to think particularly top-down. We don't need to think about exactly where interest rates are going to be for us to do well." So it just kind of brings it full circle, just like the one YouTube comment that we were saying earlier. Generally, you don't need to be looking specifically for themes. Obviously, it's not a bad thing if you are adding to your portfolio, but at the end of the day, it's cash flow, runway for growth, good balance sheet, good valuation, in line with what we're looking for at Keystone. And that was a long, drawn-out segment, so hopefully the guys are still with me.
No, actually, I actually found that extremely interesting, to be honest.
And way to tie it in at the end. It's like a Seinfeld episode.
Yeah.
Right? From start to beginning.
Yes.
Usually I fall asleep when Brandon's talking. No, I'm joking. But actually I found that it was long, but I was engaged in that the whole time. I did find it interesting. Done. So I watched segments of that podcast as well. And you know what? It's funny, well, somewhat funny, but I remember, I was following the whole Valiant story back when that was happening, and also the Herbalife. And I remember seeing an interview with Bill Ackman back then, because he was getting killed on his short with Herbalife, and he was talking about some story or something relating to that investment, and he started crying or getting very teary-eyed on the air, and I just kind of thought that was a bit of a joke. Somebody crying on air about an investment or, but in the podcast, when he was talking about that period of his life, so many things were going on. Like he got killed on Valiant. He was getting killed on Herbalife. That attracted a bunch of people that were basically trying to take over his company and displace him there. He got divorced from his wife. So he said that at the time he was really envisioning I think that there was like some other lawsuits as well, but envisioning himself being completely broke with nothing. And so I obviously had no idea that all those things were going on in his life, but it made a lot more sense that he was a little sensitive. So I can kind of understand it now. But no, I think that his investing methodology, it sounded very reasonable. It's not that different than ours. One other thing that he said about on the podcast as well is that they don't short stocks anymore.
Yeah.
Right. Like he tried to get fancy with Herbalife, and he's like, we learned our lesson there. We don't short.
It's funny. Like he talks about businesses with modest leverage now and have, he probably prefers net cash or he probably getting burned on Valiant because it was a leverage story. It levered up over time and then doubling down and getting hurt even further. There were a few other analysts, Canadian analysts, who were pounding the table for Valiant.
There were two companies. I think one other it might even have been a spinoff of Valiant, but it was also similar model. And they were just, we were following the story close back then because they were so widely touted. They were so beloved by so many analysts and portfolio managers, but the value,
it always had so much debt though. It always just, and it levered up the debt over time. It just kept, and that because it was buying not necessarily products with any growth at all. Some of them had small percentage growth, but it was buying those and it had to keep buying them to grow at the rates it was buying. And then it had to keep levering up the balance sheet. It was a bit of a house of cards.
And they got caught up in the controversy on raising drug prices, because I think that was a big part of their model, was buying drugs, they weren't doing the R&D. They were just buying patents and then increasing the prices.
Doesn't leave the greatest taste. And
I know they were in front of Congress and everything. So.
Yeah. But either way, I just thought that it was a really good interview. If people are interested, they should listen to it.
I've seen really several segments of that interview. I thought there's a lot of good information.
And it taught me a lot of like interesting things as well, just like from like the management of a fund where, the reputational risk that he took after Valiant and Herbalife basically together, where all of a sudden he has this run on funds or run on capital from his fund. And, one of the companies that I pulled up, CP Rail, he mentioned that he wishes he would have never had to sell it, but that was one of the things that he needed liquidity to, pay back investors. So that is something that he ended up having to sell. And, just seeing, kind of the managing liquidity and how, difficult of a game it can be for some of these funds, I thought was interesting. And one last thing, just to go on what you were saying of how tough his life really was getting. I agree completely. He ended up saying on the podcast that, he was going through Valiant. He, had all this reputational risk. People were pulling their money, all of it, like tons of his stocks were going down. He was going through a divorce where his, ex-wife's lawyer was thinking that his assets were 3 times the value than they actually were because, he was losing money with Valiant and whatnot. And his new girlfriend had like a photo shoot or something with Brad Pitt, and he didn't hear
and
back
wouldn't
from
return
her
his calls. Yeah.
Yeah, exactly. He didn't hear back from her like all day long. So he was like living in this play, or
yeah,
he was,
and then there was a bunch of Brad Pitt's new girlfriend all over the tabloids. So.
Yeah, exactly.
So maybe Aaron knows why he was crying now.
It makes sense now. Maybe I was a little too judgmental at the time.
So yeah, he was living in this where he's, going through this divorce, his funds basically on the verge of collapse, and he just lost his,
but it's a comeback story because he got through it and he rebuilt it, and he retuned his methodology.
And I think he wrestled her back from Brad Pitt.
I think so.
And
well, yeah, at the end of the day, we're in the business of, making, bets, and some are going to be great and some aren't going to be great. There's another quote by Bill that says that, and it's true, but at the end of the day, it's letting those winners ride.
It's about limiting the bad and then holding on to the great companies too, right? Yeah,
exactly.
That's another, to bring it full circle, that's another thing we'll be talking about in our upcoming live webinars that'll be at the end of, what is it, early May? Is that what we're doing, right? Early May. You've got it there.
Early April.
Early April. Jeez, I went way farther. Early April. It's true. They're coming up soon, which is excellent.